Hi everybody. In the spirit of getting underway in a timely manner, I'm going to make a start now. So I can see the numbers are still creeping up of people sort of getting into Zoom room, but we'll make a start. So as I said already, good morning everybody. Thank you very much for joining us today for this Accentuate by K3 Hub session, which is brought to you by the members of the K3 Capital Group PLC, which is a multidisciplinary professional services group which is listed on the London Stock Exchange. My name is Marie Wadeson and I am a Managing Director here at Quantuma, and on behalf of the K3 Capital Group, I lead the K3 Hub. So for those who don't know much about K3 Hub, this is a membership group of over 1,800 like-minded professionals, which is powered by the members of the K3 Capital Group. K3 Hub offers its members a range of benefits, which include a CPD and training program, which offer a range of structured and unstructured CPD courses. Structured CPD courses are run by Tollies on our behalf. And unstructured CPD sessions include sessions such as today's. Our members can also access the broad range of professional services offered by the members of the group. And for certain types of work that we receive, we can pay a referral fee in return. Just before we get underway with today's agenda, a couple of pieces of housekeeping from me, if that's okay. We are recording today's session and a copy will be available on the K3 Hub website in the coming days. We really do have a very full session today, and it's a very diverse agenda, and it's a tale of two halves, as is often the case with these sessions. Q&A functionality switched on. We have allowed some time for a short Q&A. We have had some questions in advance of this session. If we get more questions than we can actually respond to in the time that we have available, then I will pass any unanswered questions on to the relevant speaker, along with your contact details, and they will come back to you. Right, moving on to the first part of today's agenda then. So first up, I'd like to introduce a returning speaker and my colleague, Jeremy Johnson, who is a director at inTAX. Jeremy specialises in helping clients in proactively managing and resolving HMRC inquiries, disclosures, and risk reviews. Right, Jeremy, over to you.
Good morning, Marie. Thank you. Good morning to everybody who's joining us. Thank you for being here. I've got three subjects to just touch upon in terms of what HMRC is doing at the moment. The common theme is employment taxes. We've had a couple of Court of Appeal judgments this week in relation to IR35. There are some other things that HMRC is doing in relation to employment taxes, so I thought I'd touch upon those things. So the three areas are HMRC's activity in relation to MSCs, managed service companies, some activity that HMRC has undertaken, which is relatively new in relation to a couple of umbrella companies, and then also a very quick recap of the two IR35 cases where the Court of Appeal published judgments this week in relation to Kickabout Productions and Athol House. So to kick off with the managed service companies activity that HMRC is undertaking, by way of a brief recap, MSCs or the MSC legislation was introduced to tackle what HMRC was seeing as abuse, where people who are really employees were operating through composite companies or through companies that really they didn't manage, somebody else managed on their behalf to provide services to somebody else. Fairly recently, HMRC has issued a lot of assessments to what it believes to be managed service companies who were administered by a company called Churchill Knight and Associates, and there's been some press around that. So what is a managed service company from HMRC's perspective? Usually it will be a personal service company. It's a company with an individual that's providing services. There are various criteria. I won't run through them all, but effectively HMRC would say that if you are receiving more than you would if you were under pay as you earn, and certain conditions apply, you may be a managed service company. There also has to be a managed service company provider. So that's the entity that's administering all of the managed service companies. There are 5 criteria which can put you into being a managed service company provider. You only have to tick one of them. So you benefit financially, influence or control the provision of your client's services, influence or control the way payments are made, influence the way that the company's finances run, or promotes an undertaking that there is making good of any tax loss. The reason that this is interesting at the moment is that although accountancy firms should be exempt from this legislation, the broad nature of what may become a managed service company provider and the fact that HMRC seems to be taking more action, there is always a risk that people who wouldn't consider themselves to be managed service company providers fall into that. The consequences for the managed service company, if you do fall into this, is effectively the fee and income becomes subject to pay-as-you-earn and NICs. There are some debt transfer provisions which can mean that the debts of the managed service company can be moved onto the directors, potentially onto the managed service company provider, potentially onto the end client. So it can be a little bit draconian. So for most accountants who do operate or who do administer companies on behalf of individuals, this shouldn't apply, but it's something worth looking at just to make sure that you're comfortable that there isn't a danger that you're going to fall into this legislation or that your clients are going to fall into this. The second area where HMRC has been up to things recently is in relation to umbrella companies. The first thing I'll say about umbrella company, well, standing back first, an umbrella company is where usually you've got a company which has lots of employees who are usually contractors. The umbrella company will provide an umbrella for individuals to provide their services as contractors to end users without having to worry about self-assessment, without having to run a personal service company. And the umbrella company will usually administer everything and then pay the people subject to pay-as-you-earn. Most umbrella companies are perfectly compliant. They do everything properly. The taxes are paid properly. Historically, there have been a number of umbrellas that have operated what HMRC believes and probably are tax schemes, where a lot of the pay is coming by way of loans, so not subject to pay-as-you-earn and NICs. HMRC does not like those schemes, understandably, and recently HMRC got new powers to name entities that it believes are promoting tax avoidance schemes, and it named 2 entities who are umbrella providers, as far as I understand, fairly recently. The two companies were Absolute Outsourcing and Purple Pay Limited. I understand that they were operating some kind of hybrid mixture of pay and loans in terms of remunerating the employees of the umbrella. The difficulty with this is, although the liability potentially should end with the umbrella, quite often the people who enter into these arrangements may end up paying for this or may end up paying the tax bill at the end of this. A lot of people who work for umbrellas are not necessarily earning a great deal of money, and when they're under HMRC scrutiny, it can be very stressful, and potentially these people can't afford representation to help them out with the difficulty that they find themselves in. So the one thing that I would say to any accountants who do have clients who, as part of their activities, work for an umbrella company, encourage your clients to cast a critical eye over how the umbrella company is working, and if they're receiving a net amount that seems excessive compared to what you would expect them to be receiving if they were purely subject to pay-as-you-earn, ask some serious questions, and it may be something that you might encourage clients, if they are in what looks like to be a scheme, to move to a different umbrella perhaps. Finally, IR35. 2 tax cases were, Court of Appeal judgments were handed down this week. Athol House and Kickabout Productions. Athol House is Kay Adams. It was in relation to her, the Kay Adams show, which was broadcast on television, and Kickabout was Paul Hawksby, who was a TalkSport presenter. He had a daily show on TalkSport. Both of those cases have been through the first tier, the upper tier, and now the Court of Appeal. Kickabout's first tier allowed Kickabout's appeal, the upper tribunal allowed HMRC's appeal, and the Court of Appeal has now disallowed Kickabout's appeal. So effectively, as things stand, HMRC has been successful. The engagement is in IR35. These were both IR35 cases, people operating through PSCs and HMRC arguing it looks like there's more of an employee relationship if you stand back, and it should be subject to, the fee should be subject to pay-as-you-earn and control, pay-as-you-earn and NICs. In terms of Athol House, The first tier allowed Athol's appeal. The upper tribunal upheld that, but now the Court of Appeal has remitted it back to the upper tribunal, which must be incredibly frustrating for those involved in that litigation when they were expecting perhaps an answer to come out of that. In terms of what's come out of those judgments and the things that you might be able to take away from that, I don't think that there's anything definitive that allows you to look at any potential IR35 engagement and be able to easily say that's definitely in IR35 or that's definitely out of IR35. Both cases did go through at a high level what is a three-step test. Firstly, is there mutuality of obligation between the parties? Secondly, does it appear that the client has control over the individual who's providing the services? And thirdly, what the courts refer to as a multifactorial assessment. What are all the circumstances? The one thing that came out of both of these judgments, and both of them were heard by the same three judges, is HMRC's approach historically has been if you tick the mutuality of obligation box, and if you tick a control box, then it must be within IR35. Previous judgments, when looking at the wider circumstances, particularly in Athol and also recently in the Adrian Charles case, looked at the wider circumstances and says, well, no, there may be control, there may be mutuality of obligation, but this is an individual in business on their own account. So when you look at it from that perspective, it wouldn't be an engagement of employment. The courts in these cases have said, well, you've certainly got to have mutuality of obligation. You've certainly got to have an element of control. But when you go on to the third stage, the first two are necessary, but they're not sufficient. And so when you go on to the third stage of the assessment of whether something might be in IR35, the element, the degree of control can be looked at through the lens of the wider perspective of all the other circumstances of the engagement. So I think we'll see more. The Athol House has gone back to the upper tribunal, so the upper tribunal is going to hear that again. It's a challenging area, certainly, and certainly if you're in the media and a presenter, HMRC's perspective seems to be that everybody in that field must be subject to IR35. I don't know that at this point that we've got kind of a definitive matrix with which you can easily decide what is and isn't in IR35. But what is clear is HMRC certainly is going to continue to challenge these arrangements. So MSCs, just keep an eye on that. If you happen to have lots of personal service companies that you administer, umbrella companies, if you've got clients within that who operate like that, look out for what their net pay is and does it look wrong. IR35, I think, is going to be continue to watch this space.
That's great. Thank you very much, Jeremy. I'm very pleased to see you keeping time with your.
I didn't realise my timer was going to make a noise. My apologies.
No. Very good, very good. Jeremy, we've got a little bit of time for some questions here, and we have had an interesting one in from Andrew. So, Andrew's question reads: if a client does a status determination test and concludes that a contract is outside of IR35, is a contract clause that the contractor should bear all tax and NI responsibility if this goes wrong, something that they can, in law, pass responsibility to the contractor?
So I assume this is in relation to the change in rules where if you are a large company, you have to look whether somebody who is providing services to you through a PSC, you have to look as to whether that engagement is or isn't in IR35. If you're not a big company, you don't have to make that determination. And a large company, over 50 employees, over 10.2 million turnover, or over 5.2 million on the balance sheet. So if you are having to make that determination that people providing services to you, are they in or are they out? Quite rightly, you have to make the status determination. If you do make the status determination, and if you do that with reasonable care, the financial risk should not be with you. If HMRC decides that the engagement is within IR35, the issue lies with the personal service company or the individual providing the service. So there shouldn't be a problem. If you haven't done the status determination or you've been negligent in that, potentially it does become your problem as the end client, and it may be an issue where you're paying the you're picking up the bill for that. In terms of the actual question, if your contract says, well, if there is a problem and we have a liability, we're going to pass it back to you, I think that's probably a contract law question as opposed to a tax law question. I've seen contracts which put all of the liability onto the service provider rather than the end client. Personally, I haven't been involved in the edges of any litigation as to whether that's enforceable. I could see that potentially it could be, but I think it's a contract law question. But if you've done the job properly, hopefully you wouldn't have to rely on that clause anyway.
That's great, thank you. Another question is, Simon has asked, what can contractors do to ensure they are outside of IR35?
That's a very difficult question, and I don't think there is any one answer. I mean, certainly having a look at the factors that may tend to put somebody in or outside of IR35. How do you operate? What level of control is there? Are there things that you could do to change the way that you work, to show that you are more autonomous or demonstrate that you're more autonomous, and making sure that the contract reflects the level of autonomy that you do have, and make sure that there aren't just generic clauses in the contract which infer high degrees of control even if they're never exercised. One of the things is that some of this will depend on how risk averse your client is, and it may well be that a very risk averse client may decide that they're just going to self-assess as being within IR35 just to avoid the headache. Not ideal, but with the change in dividend rates, for many people, the difference between being in or out of IR35 in terms of the net amount they could take home is not massive. So you do see end clients who have to do status determinations, and also PSCs taking risk averse decisions and just deciding that they're in just to avoid the headache. Okay,
great, thank you. And the last one that I've had for you, Amy's asked, does HMRC approve any umbrella companies?
HMRC doesn't approve much, to be honest, or approve of much, but no, HMRC does not approve umbrella companies. It doesn't approve tax arrangements. If you ever see something that somebody is boasting is HMRC approved, it's just not. So the due diligence is down to you and your client in relation to umbrella companies. HMRC is not going to say yes or no. It's up to you to look at, is this straightforward, or is there an element of risk for me?
That's brilliant. Thank you very much, Jeremy. I appreciate that. Right, so that brings your session to a close. I'm very pleased to be able to introduce our next speakers on this, the first part of this agenda today. So next up, I'm delighted to welcome Frank Wessely and James Piper. Frank is a colleague of mine from Quantuma, managing director in the Restructuring Insolvency team based in Maidenhead. James is managing director and owner of our partner firm, Lightbulb Credit. Lightbulb is a specialist consultancy offering corporate credit rating advisory services. I'm going to hand over to Frank and James, who are going to tell you a little bit more about this groundbreaking offering. So I think, Frank, I'm coming into you first.
Great, thanks very much, Marie, and good morning, everyone. Yes, I'm Frank Wessely, and I'm a managing director in the Thames Valley office of Quantuma Advisory, based in Maidenhead. My day-to-day job is specialising in restructuring and insolvency work, and I've been a licensed insolvency practitioner for, well, shall we say, several decades. As Marie mentioned, I'm going to highlight a new, innovative, and dare I say, unique service which is being launched across Quantuma Advisory in June. But I thought it would be useful today to give our contacts a quick heads up around that. So most of you will be aware of the broad spread of professional services offered by the K3 Capital Group of businesses. And we're always looking to develop new ways to help our professional contacts and their clients. At this time, of course, many clients you work with are in the recovery phase following the pandemic. And what I'll be describing is a swift way to provide an almost immediate benefit for many of them. So this new initiative relates to corporate credit rating advisory services. It became clear to me last year that this was an area which was both fundamentally important yet generally misunderstood by businesses. Indeed, my initial discussions indicated that a company's credit rating is typically just accepted or taken for granted, and there was a worryingly low level of understanding as to what goes into creating or influencing a business's credit rating. So I'll briefly cover why this is important and how it can be positively or indeed negatively influenced. But before that, what's in it for our professional contacts who decide to use this service? Well, firstly, there's the opportunity to help your clients around a new service area which can generate fee-earning work. Secondly, there's ongoing support from your usual director contacts at Quantuma to ensure that clients are guided through the whole process. And lastly, there's the opportunity to receive commissions for client referrals. Over the last 6 months or so, I've had numerous conversations with a wide range of professional contacts around this topic. And the people I've spoken to have all been extremely positive. They're very keen to learn more, especially as this is aimed at helping businesses to be perceived correctly in their markets. So what we did was set up a partnership with James's company, Lightbulb Credit Limited, who, interestingly, are the UK's only consultancy that advise businesses in relation to company credit ratings. It's a bit bizarre. If any one of us wanted to take help or seek help in relation to our own personal credit ratings, there are many resources that we could utilize. But bizarrely, there is very little guidance around in this respect for businesses. So once I finish my slot, I'll hand over to James, who will run through a few case studies and explain in a bit more detail how the process works. So you'll all know, of course, that a company credit rating is in essence a health score, but this can vary from rating agency to rating agency as they each focus on different areas and sectors. It's clear from what I've seen that the majority of companies are wrongly rated, which is a bit worrying in itself, but it shouldn't necessarily be a surprise when you consider that the 5 main credit rating agencies are rating over 4 million live companies at this time, with over 500,000 new companies being formed every year. An incorrect rating in itself can have a significant impact on several important areas. Firstly, access to and the cost of working capital funding. A healthy credit rating is an obvious important indicator for lenders when considering requests for overdraft loans and asset finance. And in principle, the higher the score, the lower the cost of funding and the larger the potential facility. It's also important where a company already has an existing bank borrowing position, where a change in the working capital assumptions could impact upon covenants and cash flow. Secondly, it's a prerequisite for companies who work in the public sector and tender for work under framework agreements, and they must have a minimum credit rating of 51 out of 100 with a low to moderate business risk rating. And without this, they just aren't allowed to tender. Lastly, it's important for businesses who are what I call trade credit rating sensitive, as in they're reliant on maintaining good terms with critical suppliers of stocks or services. So in reality, I think you'd agree that this pretty much covers the vast majority of SMEs. There are a number of factors which can cause decreases or increases in credit ratings for SME businesses. Now, some of these can be directly influenced or managed, but others are outside any direct control. So if I could have my first slide, please. Great, thank you. So this lists out a few of the main areas that businesses can directly control or influence that have impacts on their credit ratings. So where there are changes in company officers, departures tend to have a negative impact, whilst appointments are usually positive. If the ownership of a business changes, this can be positive or negative depending on the specific circumstances. If a client creates a debenture in favour of a lender, this will at best be neutral, or more likely negative. In relation to confirmation statements, if your clients have any that are missing, this will have a negative impact on your client's credit rating. And if your client files documents outside what agencies regard as their normal frequency or pattern, this will also be negative. And lastly, data for your client, which indicates that they're taking longer to pay their bills, will be negative. Can I have slide 2, please? Great, thanks. So this lists out a few of the main broader indirect factors that can impact on a company's credit rating. For degradation of time, the older an event, the less of an impact it will have on the rating. So they have a sort of a sell-by date to an extent. Where there are SIC code or industry changes, this will depend on the specific changes, so it could really go either way. When the agencies put through scorecard changes, it can be positive or negative, as there are indeed, as James will highlight, so many variables. And if a director of a client has a separate business failure, this will always be negative on your client's affairs. So we have to date worked with a number of businesses across a range of sectors, all of whom have seen an almost immediate and significant increase in their credit ratings. These have arisen as a result of referrals from introductions via accountants, lawyers, and indeed PE houses. So that concludes my slot. Let me hand over to James now, who'll take over.
Thanks, Frank. So yeah, I'm James Piper, the MD and founder here at Lightbulb Credit. We've been going for, we just celebrated our 4th birthday just last week, actually. My background is in corporate treasury, in the construction sector, and then went to work for some private equity firms. I think credit ratings have become more important now than ever. COVID has had a devastating impact on many businesses, and we've seen today in BBC the insolvency news that's coming out. Lightbulb Credit are able to provide detailed credit data in a single report for CreditSafe, Experian, Graydon, Equifax, and Dun & Bradstreet. Presenting this to your clients as an accountant to be able to give them this free insight and unique position is invaluable at this point. And as Frank says, we've worked across several sectors. So the problem that we're aiming to solve is, firstly, information and insight and highlighting potential issues. We worked with an SME online retailer with a turnover of £2.2 million. They file abridged accounts. They'd actually done quite well during COVID. We, through our arrangement with the agency, was able to submit some off-market information, so it didn't impact their publicly available data. So what was shown on Companies House, we showed year-to-date information. We showed that there'd been a shareholder round of investments, and we improved the rating from 15 out of 100 to 72 out of 100 in 5 working days. That enabled them to raise some finance where they'd been declined. A lot of tier 2 funders will use a credit score in their algorithmic credit decision making. And it certainly improved their working capital by changing the terms that they were on with some of their key suppliers. Secondly, we did some work with a construction firm, again, had been impacted by COVID and some bad debt, some insolvency. In a previous set of accounts, we were able to work with the agency and move their rating from 13 out of 100 to 88. This enabled them to get some plant and machinery leases. They also used that rating to enable them to tender for work successfully. One of the 3 main strands that Frank spoke about is tendering. And in a lot of these processes with larger corporates or in framework agreements and construction specifically and professional service large contracts, credit scores are being used as the financial barometer when awarding potentially multi-year contracts to establish a company's financial viability to deliver over that time period. So whilst COVID has had some significant negative impacts, unless you were in food retail or pharmaceutical, you know, we've seen some significant downgrades, and the rating agencies are working on the data they have available. So it's a challenging time for a lot of businesses. And I was speaking with one of Frank's referrals just last week, and they felt that they'd sort of sleepwalked into a position where they didn't know what their ratings were. They bought a license from a particular credit rating agency that rated them moderately. What was a surprise to them when we provided the insight report was that many of their key suppliers were using a different agency. And that's the thing about the disparate market of the rating agencies. And it started to make sense to the commercial director why they weren't moving forward on progressing on some of the contracting work that they were proposing and moving forward with. So look, we can help provide insight. It's a totally free and as Frank says, unique insight at this point. We're here to help businesses. We've helped hundreds of businesses across the UK. The partnership with Quantuma is working really positively. So, you know, if there's a way that we can help your clients provide insight, and then if there's a suboptimal issue, we can help with any improvement. Does that make sense, Frank, so far?
Apologies, I went on mute. Yes, sense. Absolutely, James. Thank you.
Very good. Thank you to you both. We have had quite a few questions come in, so I'll cover them as I can. So I've got a couple in from Simon here, which I'll cover first. So James, you covered off a couple of case studies then. I think Simon's first question relates to the latter case study that you were talking about. So how did you go about increasing the credit score, please?
So we have contractual agreements with the agencies, and we have a financial template that we provide. So they file abridged accounts, so only a balance sheet. There's only 4 or 5 relevant data points for the agency, and their accounting period that they'd actually changed and extended was causing them a problem. So what we were able to do is provide year-to-date full trading data and some explanatory notes regarding the prior year's losses on exceptional items that they'd not classed as exceptional, but actually were down to a group restructuring. So it's that ability to not have a algorithmic score provided on the business, but actually have a credit analyst at the relevant agency reevaluate the score based on full information. Does that answer the question, Marie?
I think it does. Yeah, definitely. Simon has also asked, why do different agencies rank credit scores so differently?
It's a great question, Simon. The second one from you. Their algorithms are legally different, and one of the agencies for SME businesses utilizes and takes a very heavy precedent on payment data, because if you file abridged accounts and only file once every 12 months, as is your legal right, the only barometer of financial viability they have is, or they put a heavier weighting on, is how you are deemed or shown to be paying your suppliers and adhering to terms. So that is they have a heavy weighting on that. One of the other agencies is very much net asset driven in the traditional trade credit insurance way. So all of the agencies have different weightings, which is why having a single lens view of the market can sometimes lead FDs and MDs and business owners to a position where they think their rating may either be better or worse than it is compared to the wider market, which is why the breadth and the introverted view that we provide on the whole market view is key.
That's great, thank you. And one other question here that I've got, thoughts on filing micro accounts and impacts on credit rating?
So we see both sides of this in the rating. We're really big fans of the rating agencies. Obviously, we work with them closely. I'm not here to beat them with any sort of stick. They can only recommend a credit limit on the information that they have to hand. As you know, as a micro entity filer myself, I don't want to put out more financial information than I'm legally obliged to do. So I understand why businesses do that, and most businesses do file as per their legal entitlement, but the net result of that can result in a poor or a suboptimal credit rating, which is why our ability, the reason Lightbulb was born was because of this issue. So, you know, being able to share full stat accounts and year-to-date MI, contractual revenue, explanation of director volatility, shareholder support, bank support, funders, future projects. And, you know, all of this means you've got an appropriate credit evaluation based on full facts rather than abridged information from Companies House and trade payment data. Surely no more questions, Marie. You've grilled me enough.
No, sorry, I'm on a touchscreen today, and my my mouse has stopped working momentarily. Sorry for coming back in late there. No more questions. We have had quite a lot of interest in terms of how various people on today's webinar get in touch to find out more about this service and how we price it. For everybody that's made inquiries in that nature, I'm going to pass your contact details on to Frank in the first instance, who will get in touch with you later on, if that's okay. So that brings to a close this part of the session. So thank you very much to Jeremy, to Frank, and to James for your insight this morning. That's great. We now move on to the second part of today's session, which is our EOT masterclass. So I am very pleased to be able to introduce colleagues from across the K3 Capital Group this morning. So first up, we have Holly Bedford, who's a Managing Director in K3 Tax Advisory. We've got Paul Hooper, who's Managing Director in K3 Debt Advisory, and Quantuma's Adrian Howells, who is a Director in Quantuma's Corporate Finance team. In this EOT masterclass will take place over the course of the next 50 minutes or so. The team will explain what EOTs are, typical structures, and they'll be using a case study to bring to life some of the salient points. I think we have headlined this as, you know, under the banner, EOTs are great, but do come with somewhat of a health warning for advisors out there speaking to their clients about these matters. So just as a reminder, we have got the Q&A function open. Do feel free to ask your questions as we go along, and I'll pick those up as we go with the relevant speaker. We did have some questions in through the registration process, and I believe that the majority of those Adrian's going to try and pick up in his first session. So Adrian, I'm going to hand over to you, and I think in the first instance you're going to talk about just sort of give an overview of what EOTs are and the typical structures.
Perfect. Thank you, Marie. Morning, everyone. Thanks for joining us. Some of you are likely to know what an EOT, an employee ownership trust, is, but I'm going to cover this off relatively swiftly anyway, and pick up on the 8 themes that you see on the slide here. So announced as part of the 2014 Finance Act, employee ownership trusts, EOTs, are essentially a form of business structure where shares in a company are owned in a trust for the benefit of the employees. The function of the legislation was to create an alternative method for owners to sell some or all of their business. And in very simple terms, it's the case that owners can create a trust which purchases their business, and doing so does come with a great number of benefits. However, perhaps unsurprisingly, it isn't quite as simple as that, and we cover off a lot of that in this session. There are many benefits to sellers in doing this. So the transaction process is much smoother and more collaborative than you know, maybe selling to private equity or to trade, where you know parties can end up at loggerheads. And as the vendor, you remain very much in control of the process, including to a large degree in terms of timing. Because we are selling into the trust, of course, there's no requirement to go hunting some sort of lengthy buyer search and endless and often very boring management meetings. The price is set as part of this process, and so that is known to both sides throughout, and therefore you know, no last minute price chips. Due diligence requirements are reduced, and so are warranty obligations on the vendors, which is helpful. And of course, that also typically leads to lower overall transaction fees. Your legacy is preserved. So, you know, it isn't all that common anymore, but it does still happen. You know, private equity or trade pick up the business and morph it into their own sort of vision, and staff can lose jobs and all that sort of stuff. So actually, this business that you've founded and maybe run for many years, legacy is preserved, and your staff who maybe have helped you build this over many years, their sort of roles are protected. I'm saving the headline benefit and the one that most people are excited about until last. So long as you sell a majority of the shares into the trust, the transaction is entirely tax-free, so no capital gains tax to be paid. Clearly, that is a massive advantage versus other exit routes. It's important to note, however, that as the seller, you must lose sort of all control, both economic and voting, but that is not dissimilar to other exit options. Many benefits of the business. There's not that many EOTs in the UK yet. I think at the last count, which about a year ago, to be fair, it was around 1,200. I suspect it's probably approaching 2,000 by now. Many more in the US, where they've done some studies there that show that these sorts of businesses enjoy some fairly distinct advantages. So as well as providing a seamless succession solution, there's evidence that shows that because the employees ultimately stand to benefit from capital value, the business, they're that bit more engaged. That leads to increased productivity and reduced employee turnover. And that in turn leads to greater stability in the business itself. So particularly in a downturn, such businesses have been demonstrated to be more resilient. If you think about it, the staff, although they don't own the business, the trust does, but nevertheless they stand to gain from the capital in the long run. If things are getting rocky, they're that bit more likely to grab an oar and pull together to try and bring the business through any sort of difficulties. Benefits of the staff. So yes, although they don't own it, but they stand to benefit from it, but they don't have to put any money in up front. As I say, yeah, in the long term, when it's sold, they stand to gain from the capital there. And they're also entitled to an annual tax-free bonus of £3,600 at the moment. It's worth noting there, though, that all staff, including any vendors who have remained on the payroll, must participate in that in order for that to work. So some positive indicators. So what sort of businesses might this particularly suit? It is genuinely a wide variety of businesses, but it probably suits those that are relatively well established, profitable, helpful if there's already low staff churn. Otherwise, it just gets complicated in terms of who the beneficiaries of the trust are. And it really helps because of the way these are funded, which we'll come on to in a moment. It really suits businesses that find themselves in a cash-rich position. It isn't for all businesses, though. So despite these many advantages we've talked through, they're not a panacea. So aside from being very complicated to structure correctly in order to benefit from the tax advantages, because, as I've said, the staff aren't putting money in to fund the acquisition, actually the funding is therefore driven largely by free cash on the balance sheet, any third-party bank debt that you can get access to, and therefore in most instances a very large slug of vendor loan note vendor debt, and that in itself will not appeal to everyone and may rule them out. Many qualification requirements, it's very stringent, and it is absolutely the case that not all businesses actually can partake in an EOT. We're not proposing this workshop to cover those off in a great amount of detail, just because there's so many hurdles and tripwires as you go through this, but obviously we would welcome any conversation with any clients considering an EOT to try and ascertain, look, could that work for them? Could it suit them? Important here, so very significant risks if we structure this incorrectly, and that ultimately is where good advice is absolutely essential. The tests that must be met to make the EOT valid, and indeed to make to benefit from the tax advantages, they must be met basically forever or until the trust sells its shares. So that really poses problems and complexities when we're doing the structuring, and a great deal of thought and effort goes into getting it right so it's compliant in the first place and also compliant under various scenarios going forward. I really must emphasize this: if the tests have failed in the first approximately 2 years, it's on the sellers to then pay 100% of capital gains tax as if it had been a normal sale. And remember, the way we've structured this, they may not have had much value out at that point in time. So I think it's fairly obvious there, the problems that can cause. Onward sales, and we're sort of focusing on the difficulties here. I mean, they are designed, to have onward sales. I mean, if you think about it, how else are the staff going to benefit from that potential capital value in the future? But not that advantageous. So on the sale, the trust itself must pay capital gains tax on the sale, and that's at a nil cost base as well. So that erodes a lot of value in its first place. The balance then is distributed to the employees, but it's done so as employment income. And so, again, more value is eroded in this process. But I think the thing to keep in mind is that, of course, the employees haven't put any cash in the first place. The real challenge, I think, to pick up, and we get this question, or this sort of people exploring whether this is an option quite a lot, is if you want to sort of to sell quickly, so I don't know, we'll sell into an EOT, and I might only sell a small proportion, 51%, 55%, whatever, into an EOT, and maybe in 3 years' time, look to sort of spin it off either through an MBO or into a trade sale. Actually, this is particularly difficult because if you think about it up front, the trust is absolutely loaded with debt. And so any sort of, it takes a while to pay that debt down. So any sale within the first few years, actually the bulk of the consideration will go to servicing debt. And then, of course, any remaining equity owned by the vendors. Now, the trust must act for the benefit of the employees. And so, if you're in a situation where you could sell it, the employee is going to get next to nothing because of the debt burden. Of course, a trust isn't simply going to sign that off. So we tend to advise that because of this, that sellers sell quite a high proportion into the trust. Otherwise, you can find yourself slightly marooned with shares that you can't shift for many years. So I hope that covers off what an EOT is, and indeed why getting good advice is genuinely critical. I'll pass back to Marie.
Thanks, Adrian. We have had just one question in that I think I'll cover now, if that's okay. So Katie's asked, you referred to a bonus earlier on and that it was tax-free. So Katie's question reads, is the bonus tax-free for employees or is NIC payable?
I believe it's entirely tax-free for employees, but I will double check with Holly, who is our tax expert.
Yeah, so it's tax-free up to 3,600, but NIC is payable, which is kind of bizarre, isn't it? Why they didn't just make the whole thing free of payroll deductions, but that's the way they've done it. So you still have to pay the NIC.
That's great. Thank you very much for that. Holly, I mentioned in the sort of setting up of this session that we were going to base much of the session on a case study. What I did fail to mention in the sort of the teeing up is that we deliberately have a multidisciplinary team on today, and in the recent EOTs that we've successfully completed, we found that sort of holistic approach to be absolutely invaluable. So Holly, over to you just to set the scene by way of the case study.
Okay.
There you go.
So yeah, we thought it would be really useful to run this session talking through a case study, which is actually a combination of some recent cases we've done where issues have come up, which we thought were quite interesting and what you wouldn't get on a sort of normal just run through of the rules. So here we have this picture. This group here is a long-established trading group. They make flower pots. They've done really well through the pandemic, because more people have been buying nice flower pots for their gardens. You've got 3 subsidiaries in the group doing different varieties of flower pots. So our shareholders are Mr. A and Mr. and Mrs. B. In the 2 family groups hold it equally, so 50-50. They have a subsidiary A, subsidiary B, and B holds 80% of C. And in C, the 2 of the original shareholders, Bill and Ben, have retained 10% each, and they are also still directors of company C. B has civils loans that it took out through COVID, the 500,000 that's still outstanding at this point in time. And the group does have a lot of employees. It's not by any means just a family company. However, there are family members working in the business, which when we come on to the tax rules is really important. And it's something you need to sort of have a really good look at when you're starting an EOT project. And just to say that company A that's in the group was brought into the group a few years ago from Jeff. Jeff still works in the business. He's a really important director. You know, he's very critical to the success of the business. So he's still in the business. And also Jeff's son is a member of the senior management team. He's also a very important member of the business. So Mr. A is a director, Mr. B is a director, Mrs. B is in the business. Mr. A is a very understanding individual, and his ex-wife works in the business. Mr. B is also very understanding because his stepmother works in the business, and his nephew works in the business. So all very genuine employees, no suggestion of just sticking people on the payroll. These are all valued employees in the business, but it does create some issues with tax, which we will go on to later. But I'll leave you first in the in Adrian's tender care to discuss the you know, the financial, the first step in an EOT process, which is looking at the numbers, looking at the deal structure, looking at the affordability. So over to you, Adrian, to talk about that part of it.
Thank you very much, Holly. Yes, our flower pot men. So they came to us, as is the case with many clients who end up going down an EOT route, actually didn't know what an EOT was, just interested in selling their business. And so typically then vendors are talking about, can I sell to trade? Can I sell to private equity? And so as ever, we sort of sit down and look at the group, look at the complexities of the group in this instance, and note also we've got the Sybil's bank debt in here as well under B. And we sort of explore what may or may not work. And reasonably early on, we came to a conclusion, partly because of the complexities of the structure and some dynamic within that, partly because of the levels of the debt, and also although you know trading had gone really well during COVID, actually before that it hadn't been so clever. So we worked out private equity wasn't going to be an option for them and took that off the table. So we then left, as far as they're concerned, with the sort of trade option. But you know, I sort of say this to anyone working in advisory, if you're talking to someone looking to sell their business, because of the advantages that an EOT brings, certainly in terms of the tax at least, and also, as we sort of alluded to earlier, some of the keeping the structure relatively straightforward. Sorry, the transaction relatively straightforward. I think, you know, with almost all vendors, you need to discuss what an EOT is and does it suit them. And so we started that conversation. But initially, the group was keen to sort of pursue trade, and we tried that, found some interested parties. But, you know, as Holly said, sort of it's quite a conscientious group. The employees are important to them. And it was apparent for various reasons that the interested trade acquirers were likely to change the business quite a bit once they bought it and absorbed it. And the shareholders didn't like the look of this. And so obviously one of the other distinct advantages of an EOT came to the fore, which is that, you know, the staff sort of stay in situ as is. The business on day one after the transaction basically looks the same. So if you like, that's one of the key things that we start off with, if you like, a corporate finance umbrella, if you like, is actually discussing what are your options, does this suit you, and including whether, you know, some of the rules will be met, which is where we engaged Holly at this stage, but I won't cover off her bits just yet. So we concluded, yeah, we're going to go down the EOT route. So the next thing that we move on to, we've had a couple of questions on this actually. So questions, the bit I'm coming on to next is the valuation of the EOT. So we've had a question, is a valuation a prerequisite to an EOT? And who does it? So yes, absolutely fundamental. You must do a valuation. Where we are transacting an EOT, we will do the valuation, but we do so on an independent basis. And the methodologies we tend to use. So there's two that we tend to focus on most. One is sort of just an earnings multiple. The second, where it's appropriate, is to look at a sort of discounted cash flow model. But actually, for a lot of businesses, particularly sort of smaller businesses, forecasts aren't really that robust and credible, and so a sort of a DCF doesn't quite work. So in this instance, it was a multiple valuation, and that's sort of looking at what have other businesses similar to this sold for in the last few years, coming up with a multiple, and this we sort of valued at around £15 million. The important thing with the valuation is, so two things. One, it doesn't, although the entire structure gets signed off and the valuation is referenced when this is signed off with HMRC, the valuation isn't approved by HMRC. So you might think, okay, well, doesn't that lead to, you know, the vendors, and of course with them, we're sort of working for the vendors to sort of go around and say, well, let's absolutely ramp the price up as much as we can. And the simple answer to that is no, it doesn't work. A, you know, just from an ethical perspective, we wouldn't do that. B, the valuation needs to be agreed, obviously with us doing sort of, you know, doing our job properly, with the sellers, but also importantly with the trust. And although I said earlier, there's not much of a diligence requirement, but there is an element of advice that's given to the trust, particularly legal advice, and they must sign off on the valuation. So if you've gone bonkers, you know, they're just not going to agree to it. So that's very early on that the valuation is agreed between all parties. The other thing as well, in terms of going mad with the valuation, is, and this leads into the sort of the third bit here that we look at, is in the structuring. You know, one of the key things we look at is what works, what is affordable. Because if you over-egg your valuation, you are then saddling the business with an inordinate amount of debt that, you know, it might take 15 or 20 years to clear, and that just isn't going to work. So with our flower pot men group here, we reached a point where, partly because of the existing civils, partly because of the attitude, I think, towards risk and debt on part of the vendors, we concluded that third-party debt in this instance actually wasn't the appropriate route, and so it was structured principally through vendor loan notes. There's an element of cash on the balance sheet that comes out tax-free, and then we sort of structured it with vendor loan notes. In this instance, again, just because of where the valuations were, because actually the cash was quite a low proportion versus the overall value, and again, sort of the risk-averse sort of nature of Mr. A and the B family, 55% of the business was sold into the trust, because that then leaves less debt on the balance sheet for the business to service. Obviously, we did discuss at some length the downsides that I'd alluded to earlier, in terms of leaving too much, keeping too much shares in the business, and that potentially being trapped. But actually, you know, although there is a downside, actually the key thing there is more a timing point. I mean, ultimately the debt is paid down, and therefore the business can be sold. So I think, you know, so long as you act as patient capital almost, then it works. So that's what we as the corporate finance team brought in collaboration with Holly and Tax, and also with Paul Hooper in our debt team, who, although in this one we didn't put debt in, is going to talk to you now about debt going into EOT. So I'm going to pass to you, Paul, if I may.
Good morning, everyone. Thanks for sparing the time this morning. I'm Paul. I work in the debt advisory division of K3 Capital Group. My role is to assist corporates in raising finance to enable EOTs to move forward. By way of a little bit of background about myself, I've been in finance for 30 odd years, far too long to even mention, to be fair, and that's covered project finance, asset-based lending, and leverage finance. There are a number of lenders in the UK that are familiar with EOTs, and that's across the leverage finance market and the asset-based lending community. What they'll want to see is that the structure of the EOT has been put together correctly, and that all of the necessary sign-offs have been done and carried out. In addition to this, what the key thing is, it's the same rules that any lender will have around serviceability of the debt, and they'll want to. And the key issue that Adrian has alluded to is they'll want to see their debt repaid primarily before any vendor loan notes or vendor finance, which in practice will mean that it can be some time before the shareholders actually get to see the full value of the business. In the case study that Adrian referred to, one of the key issues was the level of outstanding CBILS and bounce back loans. And the lenders that we spoke to about it wanted to see those rolled in to the new facility before allowing any cash out in terms of the deal. What that meant was, in this particular case, whilst we had some offers on the table, really the deal was done on the basis of cash on the balance sheet and vendor finance. And that was the only way really we could at the stage get to the sort of valuation that had been attributed to the business. So really, again, Adrian's mentioned it, the key for the shareholder is to get as much value out as possible on day one, because clearly under the EOT, with lenders coming in and wanting the vendor finance loan that their debt repaid before any vendor finance loans, it can take some time. I think the key message that I'd like to get across is that there is a real appetite in the lending market to support EOT structures, providing they have the confidence they've been structured correctly. Each of the lenders out there have their own drivers in terms of quantum and cost structures. And what we can do as part of K3 Debt Advisory is make sure we match the correct lender to the correct business. We have done a number of these over the course of the last 12 months. Not all of them have come to fruition, again, in view of some of the issues that are around these CBILS and loans that are on the books. But we have been able to provide debt structures to enable the EOT to be really looked at thoroughly. I think that's probably all I've got to say about it. As I say, the key driver is there are lenders out there that are very familiar with all of this. They are eager to put debt into these businesses, as I say, providing they've all been structured correctly, which is where my friend Holly comes in, who is the expert on all of these things.
Thanks, Paul. Marie, do we have the slide which shows the EOT structure? Just quickly. Yeah, so I'll just quickly talk to this one, because one of the issues, the sort of beginning issues that we often have to talk to people about is how does this thing work? Just to say from the start, there are a ridiculous number of tax rules around EOTs. The basic sort of premise is quite simple, but when you get into it, look in TCGA, tax people, there are lots and lots of tests, lots of definitions that need to be considered when you're putting in this EOT and when you're running the EOT. Now, I don't plan to go through all of those today because it would just ruin your day before it even begun, and it is Friday. But we are going to just focus on certain parts of our case study where it highlights some of the practical issues that can just pop up and kind of surprise you during the process. But just quickly, I'll just quickly talk about the structure. So this is after the EOT has been put in place. We've got the parent company and the subsidiaries on the picture. Obviously, this is a simplified diagram from our flower pot example. We've got the EOT in this case holding 55%, which is what we did in our case study, and the founders have retained 45% in that top company. Now, the way that we usually put in place an EOT is just a trust, so it's a kind of a legal fiction, and the important body is the trustee or the trustees. And the usual way with a EOT is to use a corporate trustee, so that's to give limited liability protection. So we form a trustee company, and that becomes the corporate trustee of the EOT. And the usual way to do that is to make it a subsidiary of the existing group. So it's within the group, looks a little bit circular, but that's how it's generally done. Just a quick tax point, if you're thinking of using an EMI scheme for any employees, you want to make sure that that company is company limited by shares, not by guarantee. So what we have is that trustee company is the trustee of the EOT. And obviously that's just a company, so we still need some people. And the people are the board of directors of the trustee company. Those are the people who will make the decisions of the EOT, taking into account the class of beneficiaries, which is the employees. They have to work in the interests of the employees. So we've had a question already about board composition, which I'll kind of cover in the next bits that I'm going to talk about. So we said that the EOT has to have control. And the sort of first step is, of course, it's got to hold the majority of the share capital. But we have to look a bit deeper than that. They also have to have the majority of the votes, the majority of the rights to the assets, the majority of the rights to profits available to equity holders. And they have to have control over any changes that could happen to those tests above. So we have to make sure that there aren't any funny share classes, which might mean that they don't have the majority of all of those things. So that's something to check to start with. You haven't got any funny share classes. Let's make sure that the EOT really does have control. And then going a further step beyond the sort of legal, rights of the shares that the EOT holds, what about control in the kind of practical sense? Like, who is controlling this company? Companies act through their board of directors. So we look at the boards. Now, this isn't really a sort of tied down in the legislation, but the revenue are interested in it, and I wouldn't be surprised if it's something that becomes more codified going forward, is that we always say your vendors are often, in our cases, also the directors of the company coming into the EOT, and we say going forward, you should not control the board. So now we're talking about board members, not talking about shares, talking about members of the company board. We want the vendors to be in the minority on that board. So we're probably looking at bringing in new board members. And then equally, the board of the trustee company, we don't want the vendors to control that board either, because that's making decisions over the future of the company. So we don't want the vendors still having control post EOT. So again, we're going to have to think, well, who's going to go on the trustee board? And this can be quite a practical point for the vendors. Do they trust people? Who do they trust? Who's going to make the right kind of decisions? And so that needs a bit of thought. You can have the vendors still stay on the company board. You can have the vendors on the trust board, but they shouldn't be controlling it. So you will need to bring in other parties. That might be senior management. You might have the voice of the employees up on the trustee company board. You might decide to bring in a professional trustee, maybe an accountant, a lawyer, or from a trustee company to give that sort of third party feel. So could we have my case study picture back up, please, Marie? So going back to our case study, we looked at this, and to start with, we thought, yeah, this is great. We've got a trading company. We've got really sensible, motivated shareholders who understand the principle of an EOT. They're in it for the right reasons. They're not just going into the tax benefits. They want to benefit their employees. They want to kind of give back. 50-50, brilliant. So we haven't got too many shareholders to worry about. And then issues started popping out when we looked at this, because of all the different people involved. We've got Bill and Ben, we've got all the family members, and we've got Jeff and his son as well. And so let me just quickly discuss connected persons, because this comes into every test that you're looking at, really. Every important test in an EOT structure is who's connected. So we've got to look at anybody who's held 5% or more of the shares. So note the 5%, that's important, because often where employees are given a small shareholding in a company, they're often given 5% because of entrepreneurs relief. So anybody who's 5% or more is caught by these tests that we look at. So we look at anybody who's been a 5% or more shareholder, or 5% or more option holder, and in some cases even loan note creditors. And then we look at the people connected to them. And connected in family terms, this is really complicated. So you look at your spouse and your relatives. Just hold on with the relatives for a second. We also look at your spouse's relatives. And then in your relative class, we look at their spouses as well. So you kind of have to draw these diagrams. And when I say spouse, it's also civil partner. Now, the relatives, they're the normal suspects. Your spouse, obviously, your ancestors and your lineal descendants, so grandparents, children, grandchildren, all of that. In this test is also brothers and sisters. They're not always in connected parties, but they are here. But really unusually, your aunt, your uncle, your nephew, your nieces, they are also included in the relative class. So we're also looking at their spouses and that relative class of your spouse. So lots of people could be caught by this. So we need to think about all of those people whenever we're applying tests. And that's quite relevant here because we've got people holding more than 5%, down Bill and Ben. We had Jeff, who used to hold more than 5%, got Jeff's son, so he's connected. We've also got a stepmother. We've got a nephew, they're included. The ex-wife is not included because she's no longer a spouse. So she's not in this sort of connected party class. But with connected parties is a big thing, and you've got to be really careful when you're looking at the definitions to make sure you're catching the right people. So the first thing I wanted to highlight is that you can have a company that you would otherwise think is great for an EOT, and you can go, you know, racing down the path to an EOT, and then you find out that actually they can't do an EOT. And that is because of something called a participator fraction, which is one of the tests that we have to look at. So getting a bit technical, we have to look at anyone who's had more than 5% of the shares in the previous 12 months and is still an employee, and they're connected people. They can't be more than 40% of the total employee class. So if you have a company, which is a family company, where lots of people are connected, or possibly you've got a company where they don't actually have a lot of employees, they have a lot of, say, contractors, people off payroll. So they have a lot of workers, but they don't have a lot of employees. You could find that that 40% test has failed. And if that's failed in the 12 months leading up to when you think you're going to do the EOT, you can't do an EOT. So something to look at really carefully before you go too far down the process. So that's my first warning, my first scary warning. So let's talk about who can benefit from an EOT. And again, this is something that people really need to understand when they're going into this. This doesn't stop you doing an EOT, but it's quite important to understand, well, okay, if we put this EOT in place, who can eventually benefit from that? And what you can find is a lot of people can't benefit from it. And that's coming back to that excluded persons test. So really we're looking at people that have held shares and they're connected persons. But in this case, we're looking back 10 years. So anybody who held shares in 5% or more in the last 10 years is excluded. So you want to be handling those conversations right with those people to find another way to make them feel better, maybe another way to incentivize them, but not, they can't benefit from the EOT. And when I say benefit from the EOT, this is really sort of a future sale or I don't know, a liquidation, you know, when a load of money ends up in the EOT, these people can't share in that money. So in our case study here, again, we've got, you know, Jeff, his son, the family members, Bill and Ben, all of them cannot benefit from the EOT, which in this case has given, you know, some concerns, because some of those people are, you know, valuable employees. And even if a share of the EOT is a bit down the road, it kind of feels wrong that they can't benefit from it. So we're having to think about other ways to incentivize and reward those people. And one just tiny little detail as well is when we say 5% of shares, 5% of any class of shares. So let's say you set up a special share class, again, very common. You know, your founders hold BAs, you want some employees to have some incentivization shares, so you set up a B class, it's got restricted rights or something, and give the employee options over the B class. Even if it's a tiny percentage of the overall shares, they've got more than 5% of the B class, they're excluded. So you have to just be really careful with these definitions. Adrian mentioned bonuses, which kind of, for most employees, this is more the immediate benefit, is that they can have these extra bonuses, 3,600 a year tax-free with NIC every year, because it's a group controlled by an EOT. And this kind of flips on its head that whole idea that people are excluded, because now the rules say everybody has to be included, everyone, even those people, those bad people who used to be shareholders or the connected party employees, everybody's got to be included. And if they're not included, it fails the tests. The bonuses aren't tax-free anymore. The only people that can be excluded is you can exclude people in their first 12 months of employment, and people that are in disciplinary proceedings can be excluded. So, you know, but everybody else has to be under the scheme, and the scheme has to operate in a way that everybody gets something. You can't end up with only 5 people out of 20 getting something. That would fail the test as well. Everybody has to get something. The bonuses are paid by the companies. They're not paid by the trust. So company A will pay bonuses to its employees, company B to its, company C to its employees, or at least it would. But we have to check the tests in order to pay the bonuses on each of the paying companies. And in our situation here, in Bill and Ben's company, company C, they got a lot of office holders, not a lot of employees. They fail one of the bonus tests. The employees in that particular company can't get the tax-free bonus, but A and B employees can. So that's another, you know, political point that might have to be handled within the group. So the important thing about the bonuses is, and it's very similar tests in the EOT when it eventually comes to make capital distributions, is the principle of equality. EOTs are not there to just benefit the top slice of employees. They're not there just to feed money to your stars. It's about all of the employees. So you could play equal bonuses. You could just, A could decide a bonus pool and split it between all of its employees equally. You could do that, that'd be fine. Or you can differentiate to an extent, but there's only 3 ways you can differentiate. You can differentiate on the basis of hours worked by your employees, their remuneration levels, or their years of service. So you can sort of say, well, people that have been here longer are going to get more of the bonus pool than people who've only just arrived. You can exclude people who are in the first 12 months of service anyway. So each of those things can be used to differentiate the pool, but they have to be used kind of separately. A bit complicated to explain. I can explain that separately, but you can't sort of go, well, first of all, we're going to give 50% more to people with long years of service, and then we're going to multiply it again for people that are paid more. So each test has to be applied separately and everything added together at the end. So people say to us, okay, how are we going to define this bonus scheme? Everybody wants to know exactly what the bonus scheme is going to be before we go into this, so it's all going to be fair. You can't do that because there are some overriding tests. Every time you pay a bonus, you have to look at it. How's it falling out? How's, you know, using our normal model, how is it falling? Because you can't end up with the bonus pool going mainly to directors or to your highest paid employees or to one part of the business, which could easily happen just by accident. Let's say your warehouse workers happen to have been there forever and everybody else was part-time. I don't know. It could end up that your warehouse workers are getting more than 50% of the bonus pool. They got the main part of the bonus pool. Can't do that. So you need to be able to check every year that you're meeting all of the rules and adjust it. And the other overriding thing to say is these bonuses cannot replace normal pay. These have to be over and above what you already pay people. If you start trying to use these tax-free bonuses to replace normal bonuses, we'll say to people, you know what, we won't give you a pay rise this year. We'll give you this tax-free bonus instead. That breaks the rules. So that wouldn't fly. This is a benefit over and above everything else because it's an EOT control company. Now, I've been told that I'm running out of time, so I will just very quickly say future sales. If the EOT sells its shares in future, like Adrian said, it will pay capital gains tax on its proceeds. And the base cost is likely to be low because it's effectively inherited the base cost from Mr. A and the B family. That's often low in our scenarios. So they're going to pay quite a lot of tax, 20% under current rates on that. They have to pay off any outstanding debt to the vendors, all that. What they've got left is held for the eligible employees and can be paid to them as employment income. There are scenarios where, on quite an unusual sort of sale in future, but it could happen, the way the trust deed works is there will be no eligible employees for you to pay that money to. The money gets trapped in the trust, and the only thing you can do is give it to charity. So I won't go into any detail because I've been told to stop, but be really, really careful before you agree to an onward sale of an EOT-owned company. Get some advice, otherwise you could end up with it all going to charity instead of your employees, which probably won't go down well. All right, Maria, I finished.
Thank you very much, Holly. Thank you very much to you all. That was extremely informative, and I think what I've taken away from that is that there is a huge amount of sort of forward thinking to be doing before you get into sort of the EOT space. Thank you for the very efficient team in the background running this and flagging that we do have an awful lot of questions. So I'm just going to run through a selection of those whilst we still have a little bit of time. We have a number which relate to the Board of Trustees. I think broadly we've covered those. So whilst I will share all of the questions with the panelists, and we can go back separately to those who asked to ensure that we have covered off those questions, I think I'm going to leave those. So Mark has asked, is there a 10-year charge on the trust? And I'll throw that open to anybody on the panel.
Sorry, I've got a sticky mouse pad as well. Marie won't let me take my mute off very quickly. I believe not. I think
Right.
it's IHT. As long as we keep on meeting all the tests, IHT doesn't happen.
Yeah, okay, lovely. Rebecca has asked, are you seeing offshore trustees being used for EOTs?
Yes, we tend not to. The advantage of having offshore trustees is that the trust, when it eventually sells the shares, is not subject to UK capital gains tax, because it's presumably offshore in Jersey or somewhere where they don't have capital gains tax. But that's kind of seen as quite aggressive, and there's been representations made that really that ought to be stopped. It's not really in the spirit of what we're trying to do here. And also offshore trustees can be really expensive to, you know, just managing that offshore structure adds a layer of cost and complexity that most of our clients really aren't interested in. It might be different for maybe much bigger companies that are looking at doing this, but in general, we try and stay away from offshore trustees.
Yeah, okay, fair enough. Okay. A couple of questions about connected persons. I think we have covered those and sort of some of those tests that need to be sort of met in terms of you know, relations and so on. So I think I'm going to leave those, but again, I will pass them on. A couple of questions that sort of center around LLPs. So one of those questions reads, what if the business is an LLP? Can an EOT still be completed, or will it have to convert to a company?
I'm pretty sure it'd need to go to a company first.
Okay.
It's a sale of company shares.
Yep. Okay, great. And then I think I'm gonna consider this the last question. So Josh has asked, what does an exit look like for the EOT, other shareholders and vendor shareholders if they retain equity? Could private equity own a business alongside an EOT?
What does an exit look like for the EOT if they retain equity? So do you mean a partial sale by?
I presume, Holly,
the EOT sells, but the others don't. Is that there?
I've read it is we're selling the whole group. So we've only sold, let's say, 55% in the first place, but now 100% is being sold, but the vendors still own 45%. I may have misread the question, so apologies. But in which case, you know, 100% of the consideration is split. 55% would go to the trust and 45% would go to the vendors, I think is.
Yeah, so if we've got a EOT holding some, shareholders selling some, the shareholders that retain their shares, subject to the articles, could decide to sell their shares to other people. Yes, they're free to do that. Like I say, subject to the provisions of the articles about preemption rights and things like that. Could private equity own a business alongside an EOT? I don't see there's any reason why it couldn't in theory. No.
There's no reason they'd want to, though. I think it's probably commercially, it wouldn't make any sense, I think, for private equity, because they'll be in a minority position. They can't control when they exit. And if you could find me a private equity house that would do that kind of deal, I'd be very interested.
Yeah, I mean, we do see private equity holding minority interest, but, you know, just minority interest. But I think their objectives would not match probably the objectives of the employees, and the trust has to act in the interest of the employees. So you probably wouldn't get a nice, harmonious position there.
That's great, thank you. I'm conscious that I'm still seeing questions coming in. I'm going to draw a line under the questions now. If the team in the background running this session would be kind enough just to take a copy of all of those questions, what we'll do is we'll circulate them to the panelists after this session, and if we haven't come back to you and responded to your question individually, we will come back to you following this session. So just by way of wrap up, thank you very much to you all for joining us. Thank you for our speakers. I think to summarise, EOTs can be brilliant, but they're not for the faint-hearted, and there's an awful lot to think about. So whether it's support on deciding the sale price, deciding on how much of the business to sell and the deal structure, sourcing external debt, or tax advice and HMRC clearance, our multidisciplinary team are experienced in successfully completing these EOT transactions, and we'll instruct the chosen legal partner on setting up the EOT and producing the necessary legal documentation. I think that pretty much draws a close to today's session, and we're broadly on time here, which is great. Thank you to everybody that has attended. And there's a couple of slides that are just sort of appearing on the screen now that have the speakers' contact details on that appear throughout the session today. And I think all that I'm left to say is thank you very much again to all of those delegates that have joined us today. And I hope you have a lovely long bank holiday weekend.
Thanks.